Welcome to Get Started Investing, where we cover everything that you need to know to kick off your investing journey. We cut through the noise and help you take the next step, and we have a bit of fun along the way. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. Very excited for this episode. We are answering a community question from Anna, all about core and satellite portfolios.
Hey equity mates, I've been setting up my portfolio with a core and satellite approach. I feel like my core is pretty well set up. I've chosen a handful of ETFs, but now I'm thinking how much focus should I be putting into my satellite stocks? I feel like my selection's been a bit random. How do you know when the balance between core and satellite is right? Thanks.
Thanks for the question, Anna. Keep them coming. If you have a question that you'd like us to answer, there is a link in the show notes and description.
All right, well, let's answer Anna's question. But before we do, we should define some of these terms because core and satellite might be a new term for a lot of people. And in essence, I guess it's like a way that you can set up your investment portfolio. And you can set it up with two separate parts that both sort of serve different purposes, a core and a satellite. So let's start with core. What is it?
Core for me, Ren, is the bulk of my portfolio that I'm holding for the long term. That is the strength. I'm doing this because I'm thinking about my core.
For people who are watching on YouTube, Bryce has like started putting his hands over his abs.
Well, it's a good analogy, and I know we'll use an analogy later on. But the core is like the strength that keeps me. My core is my strength that keeps me standing. That supports the rest of my body, and that's kind of how you can think about core portfolio.
Sure. So, side note, core and satellite is actually like a nonsensical pairing of things together.
Yeah.
You know, like it's not like it's a clean metaphor of two things. It's not like Earth and satellite or something, but anyway.
No, yeah. It's a phrase that was coined by Vanguard, I'm pretty sure, back in the day. But anyway, in terms of investing, it's those long-term investments that are low cost, that are passive, that just tick away over a long period of time that I don't really have to think about, but form the strength and the foundation of my investing strategy.
Yeah, and I think importantly, with your core, you're not trying to beat the market.
Yeah.
You're just trying to get the market average return. And then that is juxtaposed with the satellite, the second part of the portfolio, where you are making investments that you're trying to outperform the market. You're trying to beat the market, you're trying to do better. You might be looking at active managers, you might be buying individual stocks, you might be looking at other things like cryptocurrencies or whatever. You're looking for higher growth, you're taking on more risk. And that's the satellite portion of your portfolio. It's not the main part of your portfolio. It's the satellite around the edges.
Yeah, you're having a bit of fun.
Mate, core portfolios are fun.
It's the party portfolio.
So, we criticize the analogy, but let's use an analogy to explain it.
Yep.
Let's use the satellite part of it rather than your abs. That was all a bit...
The space part.
Bit weird. But, your core is the Earth, rock solid, a good chunk of your total investment. It's diversified, it's got different landscapes, different continents, different oceans.
Nice.
It takes care of itself, it's got its own systems, ecosystem, atmosphere, all of that.
Yep.
It just ticks away, it does its thing, you don't need to interact and engage with it that much.
Yeah, and it's enough.
And it's enough.
Yeah,
it's more
that's
than
all
enough.
you need.
Then you've got your satellite. Now it's out there.
Yeah.
It's orbiting the Earth, so it's sucked in by the gravity a little bit, but it's venturing into new frontiers and new possibilities. It's riskier. Things could go wrong out there.
Yes, yeah.
It doesn't have the systems to take care of itself. You need to constantly be making sure things are okay and bringing it back to Earth before things go wrong. But you're out there and you can perhaps see things that you can't see from Earth.
Yes, if you do, and if you manage to strike it out there, the rewards can be very fruitful.
Yeah.
The risk can be worth the reward.
All right, have we tortured that analogy enough?
That's a way to think about it. But the question is, who is this approach for?
Look, I would say anyone who's thinking about long-term growth. But I think particularly anyone that doesn't have a hands-on financial advisor that's helping them build their own portfolio and making active decisions and monitoring their portfolio. I think for sort of long-term investors that have a day job, that have responsibilities, that can't be really monitoring the individual investments the whole time, I think this is a good framework to approach investing.
Yeah, absolutely. So let's have a look at the core, because there are different views on what a core can be. Now, we said at the start that it's those long-term, low-cost, diversified investments, but there are different ways in which you can get that.
Yeah, or just different schools of thought. Like we've had experts on the show that would talk about like blue chip safe stocks as core holdings.
Yeah.
You know, they might look at like a Woolworths or a BHP. We've had people on the show that might think of active managers, like fund managers, as core holdings. But my view, I don't want to put words in your mouth, but I think I can probably safely say our view is that core is really reserved for those truly timeless investment options, ones that you can put in a bottom drawer, set and forget, and be confident that they'll tick away. And for me, the only investment in the stock market that fits that bill is an index fund.
Yeah, I couldn't agree more. That's how you and I both do it. And, you know, we are the index boys, so that kind of makes sense. So if you want more on indexes, we're actually doing a series with iShares at the moment on the beauty of index investing over on Equity Mates Investing podcast. So make sure you check that out. So it's all good and well for us to conceptually talk about this strategy, but why is this a strategy? Well, does this strategy work, I guess is the...
Yes.
Nice.
Next question.
How well does it work?
Pretty well. So I think it works in two ways. And I think this is the really important thing when it comes to core and satellite. You're not giving up returns.
Yeah.
So the first way it makes sense, we've kind of already touched on, it's a way to put most of your assets in something that isn't going to take a lot of your time. So you can sort of set and forget. You could dollar cost average, and every time you get paid or every time you have a bit of money saved, you can put a little bit more in, and you can be confident that it will just tick away over time, giving you the market average return. So that's the first way that it works. But the second way it works is that the majority of your investments are going into the thing that is most likely to do the best, which is really what we want to do as investors. And a lot of people think index ETFs are boring. We don't, because we're the index boys.
Yes.
But the fact of the matter is it's hard to outperform them. It's hard to outperform the market's average return. And don't take our word for it. Take the global investment giants, S&P Global, who track this kind of thing with their SPIVA scorecard. We can include the link to their scorecard in the description in the show notes. But here's a summary. Over the past 15 years, the percentage of Australian fund managers that outperformed the ASX 200 index. Do you want to have a guess?
It's in the 80s.
They're the
So they're outperformed it's sub 15%.
You're right. Yeah. 14.6% outperformed, 85.4% underperformed.
Yeah.
To use the core and satellite analogy, only 14% of the satellites outperformed the core. Let's head to the US. What do you reckon over there?
Very similar.
Yeah, in the last 15 years, 12% of professional active fund managers outperformed the S&P 500.
Yeah.
And that's why we think, indexes are very popular now, but they're still underrated. And that's why that's why this core and satellite approach works.
So, how do we get the mix right between core and satellite?
Well, I think the starting point is what we were just talking about, that the core will outperform most of the time.
Most of the time.
And so you want the majority of your assets in the strategy that is most likely to outperform.
Yeah.
And so, from there, we'll start to think about what your goals are, how much time you can commit to investing, how much time you want to commit to investing. But if we start at the sort of, you want your core to be bigger than your satellite, you sort of see people's core portfolios range from maybe like 60% of their investment assets up to, to be honest, up to 100% of their investment assets. You don't need a satellite portfolio.
I was just going to say that, yeah. It can be a misleading strategy where you're constantly hearing it as core and satellite, meaning people may be confused that you need a satellite for it to be the appropriate strategy, but there's nothing wrong with just core.
Yeah.
Yeah.
Yeah. But, like the most common ones you sort of will see are like 60-40 or 80-20 or 90-10.
Yeah.
And it will also change over time. how much time you've got, how much money you want to invest, or all of that stuff. But I think as a general rule of thumb, those are some of the numbers that we can start with.
Yeah. So that balance, that 80-20 is generally that's a reflection of my portfolio. I think you're more on the 60-40 because you love having a little punt on, not punt, but you like having a go at some more active stuff. But I think what you'll find, it'll naturally resemble how much time you actually just put into it.
Yeah.
And some people will find that it's way easier and they have the time to regularly invest through DCA and automation into a core portfolio, and you don't actually have a lot of time, and your portfolio will naturally grow into a core and satellite that reflects that.
So let's close out this episode by drilling down on satellite in particular.
Yep.
So let's start by talking about our satellite portfolios,
Yep.
and then let's finish with some do's and don'ts that Anna can take away when she's thinking about getting her satellite right.
Love it.
So what does your satellite look like?
My satellite is less than 10 individual stocks. It has been more at times, but if you're following my journey, you know that I'm consolidating a couple of active managers and a decent chunk of crypto that if it does go to zero, I will care.
Oh, okay.
Yeah. Well, I mean, it's grown to a size. Let's put it that way. Yeah, it's very nice.
Look, my satellite portfolio is similar, probably between 10 and 15 individual stocks. I have 4 active managers that all sort of invest in different ways or have different approaches that I like, and then a tiny bit of crypto as well.
Question then, why do we both consider active managers as part of our satellite and not core?
So for me, as we said earlier, like the index ETF is the core because it's like set up to be truly timeless. Quarterly rebalancing, like in theory, it could last forever. Like an index is an kind of infinite thing,
Yeah.
and it will just keep rebalancing as new companies come through and other companies fall off. Active managers, even active managers that have long-term investment approaches, are not indefinite.
Yeah.
You know, they might talk about a 5 to 7 year time horizon, but the other thing is you've got to be mindful of, is there personnel change? Like, is
Yes.
there different people managing it? Is their strategy underperforming for a long period of time and
Yeah.
just not working? Like, you've still got to think and reflect on and analyze the active managers you've chosen.
Definitely.
So because it requires that attention, anything that requires attention for
Just
me
gonna say
is a
that.
satellite.
Yes.
Yeah.
Anything that I can't put in the bottom drawer.
Yeah, can't
Have
automate,
to pay
dollar cost
attention,
average,
yeah.
bottom drawer.
Agreed.
Yeah.
Agreed. So the do's and don'ts of the core satellite for you, Anna, to take away some action, and obviously everyone else listening. But Anna, thank you for the question. Let's start with the do's. Think about your goals. You've got to start there. Plan a core and satellite that helps you achieve those goals. And if that goal is nothing more than setting up something that you can invest in over a period of time and do nothing else, then 100% core is more than fine.
Yeah. I think another do is assess and rebalance your core and satellite mix over time. You'll have different amounts of money, different life stages, different amounts of time. It's worth just reflecting on that. But also, your portfolio will move over time. Like, if you absolutely crush it in your satellite portfolio, at different points you might want to rebalance some
Yes.
of that. You might want to take some winnings off the table and put it back into your core.
Yes.
Yeah.
The third one is, don't think that the satellite is just play money and go out and buy a whole bunch of random shit just because you've told yourself you have 30% to play with. Still have some purpose around it.
Yeah, have an intention
Yeah.
with that money.
Yeah.
If it's just, and I think, this leads on to our fourth do as well, which is watch out for overlap. Like, if you've said, I've got 30% of my money in my satellite, and I've got like an S&P 500 index in my core, and then I'm going to go and buy Apple and Microsoft in my satellite, I would ask you what's the intention of that investment, given that Apple and Microsoft are the biggest holdings in your core ETF already?
Well, investor confession. If you want to listen to more investor confessions, head to Equity Mates Investing Podcast, where we're doing that as a segment. But I am in that position. One of my satellite positions is Alphabet.
Okay.
And I also own, obviously, the tech indexes.
Now, and there's nothing wrong with that, but you have to be intentional and say, I want additional exposure to Alphabet in your case because I think it's going to outperform.
It's actually just a tax reason at the moment. It was a tax reason. I didn't want to. I would have capital gains back in the last financial year. I didn't want to get rid of it.
Yeah. Makes sense. So there are a few do's when you're thinking about it. And as you said, Bryce, like, you don't have to do a satellite,
Yeah.
I think is the biggest do or don't.
Yeah, well, I think that's the first don't.
Yeah,
You don't
it's
have
a
to have a
don't.
satellite. Don't do it if you don't think you have the time or energy or knowledge to go out and pick individual stocks or find out which fund managers are the right ones to invest in, or if you want to invest in alternative assets. Don't do it if you don't want to.
Yeah.
That's the first one.
I think another don't is don't ignore your core. And now, which is completely counter to what we've
Yeah.
been saying earlier in the episode, which is, like bottom drawer, set and forget. You don't have to think about it. But I think the reason that I'd say don't ignore it is just because the velocity of new things coming to market is pretty high at the moment, like new ETF providers and new ways of investing. And the only reason I say don't ignore is because what we've seen is like a real race to the bottom in terms of fees and the like. And so just keep half an eye out and think, is there a better option than when I set up my core? Not necessarily that you need to change all the time or anything like that, but it's just we're in a pretty good place at the moment as everyday investors. Like our options are increasing pretty quickly, and it's worth just keeping half an eye on, is there a better option out there?
Yeah. Third one is don't diversify for the sake of it. And what we mean here is don't go out and just buy as many things as possible in the satellite. The main reason you're trying to do a satellite is to outperform. Often you'll get outperformance in being concentrated and just taking a few swings rather than heaps.
Yeah.
So just be mindful of that. You'll probably find, at least in my experience, that your cadence or quantity of investing is far greater in your core than making investments in the satellite.
Yeah, well, I mean, to speak to my experience, we get paid every fortnight here at Equity Mates, and I have an automatic transfer set up to a broker that automatically invests in my core portfolio. So every fortnight, I'm dollar cost averaging into my core portfolio. I'm certainly not investing that frequently in my satellite.
No.
And then a final don't as we close out this episode, don't be a collector. And what we mean by that is people will often find in their satellite, they might have like 30 positions and all of them might be tiny. And you've got to just wonder, like, what is that actually doing for your portfolio? If one of them does really well, because it's such a tiny investment, it's not going to make a meaningful difference to your financial position. So don't be a collector, have limited, meaningfully sized positions. That's probably the best way to set up your satellite.
Love it, Anna. Well, thank you so much for the question. If you have a question you'd like us to answer, leave us a voicemail. The link is in the show notes or description. We love hearing from you, whether it's a question or if you're just sharing something that you've learned on your investing journey. Please do send it through so we can share it with the rest of our community. If you want to become an Equity Mate yourself, congratulations by listening to this episode or watching on YouTube. You are well on your way. All you need to do is subscribe to the podcast or our YouTube channel to become a valued member of the community. As always, Ren, great to chat. We'll pick it up next episode.
Sounds good.